This is your Lead Left podcast for the week of July 1st. I'm Randy Schwimmer. Welcome back. This week we visited the Florida Public Pension Trustees Association 40th Annual Conference in Orlando. In our keynote presentation on Monday, we highlighted the various macroeconomic factors that form the backdrop for investors today. While researching for our speech, we came across this interesting fact from KBRA. 42% of the companies in the Russell 2000 index are unprofitable. We had to rewind the tape to make sure we got it right, but yes, almost half of the smaller companies from the broader Russell index are losing money. Now, it's fair to ask whether some of these companies are investing for growth, hence cash flow negative, or expenses are simply outpacing revenues, and it would be helpful to compare today's measure with each of the last 5 years to see if higher rates could be the culprit. To some extent, businesses being under financial pressure should not be a surprise. The cost of debt capital has soared over the past 2 years. The cost of energy and housing and some raw materials continues to be higher than historical averages. Growth is slowing in the U.S., with some economists scaling back from previous GDP estimates of 2.4% to 1.5%. Yet public equity markets have demonstrated market exuberance this year in the face of those headwinds. All indices have hit record levels, with only the Dow Jones off from its 40,000 high. Of course, stocks have been propelled by sector focus, with almost 20% of the Dow being tech stocks and 30% for the S&P. The Magnificent Seven, representing 40% of the Nasdaq 100, is an extreme example of industry concentration. The market cap of Nvidia alone was $3 trillion at one point, vying with Apple and Microsoft as the world's most valuable company. So much for diversification. Great when tailwinds are supporting that sector, but when not, you may get caught in a downdraft. Are valuations in AI and tech overblown? Well, we'll look to the experts for that answer, but concerns about rapid climbs in stock prices can lead to pullbacks, as we saw this week when Nvidia lost $430 billion in value in 3 days. Such is life in the fast and furious tech lane. Back in the credit lane, our observations suggest growth is slowing for middle market companies. Even in business services and other defensive arenas supported by private equity sponsors, we've seen revenue increases in the mid-single digits, not low double digits as we saw prior to rate hikes. Next week, we take a look at sector performance in private credit and how it makes sense to compare to the tailwinds seen today in some public equities. Coming at you not so fast and furious from the lead left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.